The question is not whether you need a plan, because if you own a business, you absolutely need a plan. The question is whether you are going to build one now when you still have time to act and to structure it the way you want to structure it, or later when most of your options are starting to squeeze, if not are gone. So let us show you exactly what we mean by this. So the exit clarity framework has 4 components. We're going to walk you through each one of them. And at the end of this section, we're going to stop and do a little project, a little exercise together. And so you're going to calculate your own rough value gap in real time.
So most business owners, they know their EBITDA. Very few have ever calculated what they'll actually net out at the end. So let's run through just a straightforward example first. Suppose your business generates $2 million in annual EBITDA and the industry multiple in your sector is 5 times earnings. You're looking at about $10 million enterprise value. That's the number that you've been building towards. Okay. Now, here's where the waterfall what the waterfall typically looks like. $10 million in enterprise value minus outstanding business debt. Let's use 2 million as an example. We're now at 8 million. Take out federal and state capital gains tax, depending on your state and how the deal is structured. That runs between 20 and 35% of the taxable gain. You're now looking at somewhere between $5.5 and $6.5 million. Minus transaction costs out of that, investment banking, legal, accounting, which typically run 3 to 7% on a deal this size, and you're roughly $5 to $6 million.
And that's a pretty significant hit. And the challenge is we haven't even touched, we have not yet touched like on the deal structure provisions, right? If there's any earnouts or holdbacks or seller financing or, seller equity buybacks, all of which affects how much of your proceeds you actually receive at closing versus receiving them over time. And so the business you thought would net you $10 million may net you 5. And that is not a worst case scenario. This is a typical scenario when there has been no proactive planning.